Hello, everyone. Maybe you already know that on May 7th, 2025, the Federal Reserve announced it would keep the federal funds interest rate steady at 4.25% to 4.5%. Though many economists expected this decision, it goes against President Donald Trump's repeated calls to cut rates to stimulate the economy. President Donald Trump even branded Fed Chair Jerome Powell a fool on Thursday after the central bank announced the pause in rate cuts and warned of higher risks to inflation and unemployment goals. Why did the Fed decide to hold its ground? How does this impact your investments and wealth? What can we expect from the Fed for the rest of 2025? Today, I'll discuss and analyze these topics to help manage your wealth well. The Fed's decision was rooted in a complex interplay of current economic stability and looming uncertainties, particularly those arising from recent trade policies. The U.S. economy exhibited signs of resilience at the time of the decision. For example, in March 2025, employers added 228,000 jobs, retail sales jumped 1.4%, and personal consumer spending levels rose 0.7% in March 2025 compared to February 2025. Some other indicators also remain robust than expected and show signs of a stable economy, suggesting that the economy was on solid footing. In such a stable environment, the Fed recognized that altering monetary policy could introduce unnecessary volatility. Maintaining the current interest rate would provide a sense of predictability, which is crucial for businesses and investors making long-term financial decisions and would further benefit economic strength. However, the economic landscape was not without its challenges. President Trump's implementation of extensive tariffs, including a 145% tariff on Chinese imports and a 10% baseline tariff on goods from other countries, introduced significant uncertainty. These tariffs were intended to protect domestic industries, but had the potential to increase consumer prices and production costs, thereby fueling inflation. The Fed was particularly wary of this scenario, as rising inflation could erode purchasing power and destabilize the economy. The concern further makes the Fed cautious when adjusting the interest rates. The Fed thinks that before the risk materialized, it shouldn't have proactively changed the monetary policy to increase uncertainty in the market. Hence, the potential risk of Trump tariffs and ensuing inflation doesn't allow the Fed to adjust the interest rate easily to maintain market and economic stability. With the implementation of extensive Trump tariffs, there will be a potential risk for inflation and higher production costs. The consumer demand may become lower, leading to an increase in unemployment. Thus, it raises the risk of stagflation, characterized by stagnant economic growth, high unemployment, and high inflation. This phenomenon, last experienced in the U.S. during the 1970s, poses a significant challenge for policymakers. The Fed's dual mandate is to promote maximum employment and maintain price stability. Stagflation threatens both objectives simultaneously, making it imperative for the Fed to tread carefully. As a policymaker, the Fed acts reactively rather than actively. Thus, the Fed has to be cautious and await the actual data trend to make the final decision. Officials in the Federal Reserve agree that Trump's tariffs will cause inflation, and the effect may appear in the second quarter. However, there is a disagreement over whether the inflation is one-time or long-term. Some officials believed any inflation resulting from the tariffs would be temporary, others feared it could be more persistent. This divergence in views underscored the situation's complexity and reinforced the decision to maintain the current interest rate. In summary, the Federal Reserve's decision to steady the federal funds interest rate was a measured response to a stable, yet uncertain economic environment. By maintaining the current rate, the Fed aimed to preserve economic stability while remaining vigilant to the potential risks posed by recent trade policies and the threat of stagflation. The Federal Reserve's decision in May 2025 to keep the federal funds interest rate steady at 4.25% to 4.5% carries significant implications for personal wealth, particularly investing and debt management. A stable interest rate environment offers a degree of predictability for individual investors. Stock markets often respond positively to such stability, as it reduces uncertainty and allows for more confident investment decisions. However, the unchanged rates also mean that returns on savings accounts and fixed-income investments like bonds may remain modest. For instance, while high-yield savings accounts may offer better returns than traditional ones, they still lag behind potential stock market gains. Investors may need to reassess their portfolios, balancing the desire for higher returns with the need for risk management. Diversification, combining equities, bonds, and other assets, is crucial to navigate the current economic landscape. On the debt side, steady interest rates mean that borrowing costs for existing loans, such as mortgages, auto loans, and student loans, are unlikely to increase soon. This provides some relief to borrowers concerned about rising monthly payments. However, while rates are stable, they remain relatively high compared to historical lows, which can still strain household budgets. For those with variable rate debts, such as certain credit cards or adjustable rate mortgages, the current rate stability offers a reprieve from potential increases. Nonetheless, exploring options for refinancing or consolidating debts is advisable to secure more favorable terms, especially if there's an opportunity to lock in lower fixed rates. In this environment, individuals should still focus on long-term financial planning. This includes building emergency savings to cushion against unforeseen expenses, paying down high-interest debts to reduce financial burdens, and considering investment opportunities that align with their risk tolerance and financial goals. It is vital to stay informed about economic indicators and potential shifts in monetary policy. Changes in inflation, employment rates, or other economic factors could prompt future adjustments to interest rates, impacting both investments and borrowing costs. Then, what could be expected of the Fed's future rate movement for the rest of 2025? The central bank's decisions will hinge on evolving economic data, particularly inflation trends and employment data. Experts forecast the economic trend differently and expect the Fed's next moves variously. Some anticipate the Fed will steady the current rates if inflation remains elevated. Conversely, others expect there could be room for rate cuts if trade policies slow economic growth significantly. The Fed's projections from March 2025 suggest a median expectation of 2 rate cuts by year-end, potentially bringing the federal funds rate down to 3.75% to 4.00%. So the Fed leans toward the possibility that Trump's tariff policies will slow down the future economy. Now, let us analyze the following indicators further. Inflation. The Fed aims for a 2% inflation target. However, March's inflation remains above this level at 2.4%. Many agency analysts and economists believe that Trump's tariffs, especially with China's tariff at 145%, will inevitably raise inflation. However, Trump's tariffs on other countries aim to solve trade inequality, forcing them to renegotiate with the U.S. Now, everything is going forward as Trump hoped. Many countries actively seek opportunities to discuss and negotiate with the U.S., hoping to lower reciprocal duties. On May 8, 2025, the U.S. and U.K. finalized a trade agreement, significantly reducing tariffs on key exports. On May 12, 2025, the U.S. and China agreed to a 90-day tariff reduction. The U.S. reduced tariffs on Chinese imports from 145% to 30%, while China lowered its tariffs on U.S. goods from 125% to 10%. This temporary measure aims to de-escalate trade tensions and provide a window for further negotiations. As of 2024, China accounted for approximately 13.3% of total U.S. goods imports. This positions China as the third largest supplier of goods to the U.S. If tariff reduction can be achieved in the long term, inflation pressure will naturally be reduced. Also, the U.S.-China deal can push other countries to imitate the agreement and accelerate the negotiating process. Thus, the elements that raise economic uncertainty will weaken, even though they will not disappear. If everything goes as Trump hoped, even though the risk of inflation rising can't be obliterated, it can be reduced significantly. So, from the perspective of controlling inflation, I think the Fed may continue to steady the rates instead of having the rate cuts, as it may push inflation further against its 2% target. Employment. The labor market has shown resilience with steady unemployment rates. Yet, any signs of weakening could prompt the Fed to consider rate cuts to support job growth. I made a video discussing whether a recession would come to the U.S. in 2025 and concluded that there were few opportunities for one. Without a recession, there would be no worry about employment, and the U.S. would still keep its strong labor market demand. In this case, making rate cuts to stimulate the economy is unnecessary. Thus, the Fed just needs to hold the interest rate steady and maintain long-term economic stability. The Fed emphasizes a data-dependent approach, and officials have expressed the need for more clarity on economic trends before making significant policy changes. This cautious stance aims to balance the dual mandate of promoting maximum employment and ensuring price stability. So, if the external environment causes the economy to move in the direction we analyze, the Fed is expected to keep the interest rate unchanged in the remainder of 2025. Raising interest has few chances. In summary, the Fed's decision to hold interest rates steady on May 7th reflects a cautious strategy aimed at economic stability. This decision was rooted in careful analysis of the current economic situation and the potential risks caused by tariffs. The unchanged interest rates mean stable borrowing costs and predictable market conditions for individual investors. Though savings accounts and bonds may also not see higher returns, this decision supports steady growth for individual long-term investments. Even though the analysis expects a stable interest rate through the remainder of 2025, how the Fed handles the interest rate depends completely on the actual economic data trend. If you find this video interesting, subscribe to my channel for more videos. Thanks for watching, and I'll see you in the next video.